Going to explain on MFRS 108, accounting policies, changes in accounting estimates, and errors. So at the end of this topic, you should be able to differentiate between accounting policies, accounting estimate, and correction of errors, and you should be able to describe the accounting treatment for the changes and how to do the adjustment for each changes in accounting policy, estimate, and the errors. Okay, so the objective of MFRS is that to prescribe the criteria for selecting and changing accounting policies. Okay, the main idea is to make sure that the preparer of financial statement, okay, which is the company, should provide a relevant and reliable financial statement for the users so that they can make decision making using information provided in the financial statement. So we need to provide a relevant and reliable information. So under MFRS 108, if there is any changes in terms of the accounting policies or estimate that has been done by the company, it must be adjusted accordingly so that the relevant and the reliability of financial statement remain. Okay, so accounting policy is defined as a specific principle, basis, convention, rules, and practices adopted by a firm in preparing and presenting the financial statement. In short, it is actually a policy is the practice that is chosen by the company, because different company may have a different policy. So when we talk about principle, it is actually a rules that every company must abide to that rules, but in terms the standard allow flexibility in terms of what method that the company choose in presenting information in the financial statement. So these the chosen policies, okay, the chosen practice is called the accounting policy. What is the accounting policy of the company in treating certain item in the financial statement? Okay, just to brief on the accounting principle, okay, because it is a rules and benchmark in accounting field. So these are all the principle where the company need to, okay, a company is considered as an economic entity whereby the personal transaction cannot be mixed up with the business transaction. Okay, financial statement must be prepared in a conservative manner in which the profit or the revenue cannot be overstated. Okay, asset cannot be overstated. Okay, and also a revenue will only be recognized when it is earned. Okay, that is basically touching on the conservatism. Okay, and we also have principles such as historical cost, going concern, materiality concept, reliability, revenue. So these are all the principles that need to be complied when you prepare the financial statement. Okay, however, accounting policy is how are you going to present your information in the financial statement. But so it is a policy is actually referring to the practices that is chosen by the entity. Okay, so this policy must be consistent because the principle of preparing financial statement, it must be whatever the policies that is chosen by the company, it must be consistent. It means that if you have adopted one method, you should continuously applying those methods to ensure that there is a consistency in the information provided by the financial statement. Why do we need to be consistent in providing the information? So that our financial statement is comparable. Okay, there are two ways of comparing the financial statement in terms of the trend analysis, whereby the company may want to see the performance of the company over time. How is our performance? How is the performance this year as compared to the previous year, last 2 years, and last 3 years? So when you are adopting the same method or the same policy, therefore the information that you provide in the financial statement is comparable. Okay, or this consistency is important when you want to compare your financial statement with other companies, with your competitor. So you also need to be consistent so that those information provided for your financial statement is relevant. Okay, because if you keep on changing the policy, that means it will result in a different figures in your SOP and your SOPL. Therefore, it may influence the comparability of the figures between years and between different companies. All right. So this is basically what we need to emphasize when we prepare the financial statement, that the information that we provide in our financial statement represent the faithful financial position and financial performance of the company. It reflects the economic substance of transaction. It is neutral, which is free from bias. They are prudent and they are complete in all material respect. So that's why MFRS 108 is important, so that if there is any changes, you must know how to adjust in your financial statement. Okay. All right. Now, this is example of accounting policy, which is you may have MFRS 123 borrowing cost, and how you are going to treat the borrowing cost. Borrowing cost is simply interest on loan. Okay, interest on loan, and then a government grant, which is covered under MFRS 120. Okay. Also we have inventory, that is MFRS 102. Where company may choose to use first FIFO method or weighted average or LIFO. LIFO is not allowed in Malaysia, I think. So only these two methods. So which method do your company choose to measure your inventory? So that is accounting policy. So if we refer back to the topic that you have learned, under PPE, you may measure your PPE under cost model or revaluation model, and IP either as a cost model or fair value model. Your intangible asset, either you measure using cost model or revaluation model. So these are the method that is allowed, in which company can choose which method, right? Which method they want to use for their assets. So the one that you choose is referring as accounting policy. Okay, so can you change the accounting policy that you have adopted? Yes, there are two cases. First, it is required by the standard itself to change the practice or the policy, or it could be the voluntary change. You yourself, the company itself, want to change the policy, probably because the new chosen policy provide a more reliable information in the financial statement. Okay, so you must have the company must have a reason to justify why the change is needed. But of course, when you change, again, you must be consistent to apply the same policy along the years, okay, in the subsequent years. Okay, I can skip this. Okay, like I mentioned just now, it must be consistently applied. Alright, but once you have changed the policy, you must maintain at the same policy that you have selected to ensure that your financial statement is comparable. Okay, now when we talk about change in accounting policy, so how do you adjust the change? It must be done retrospectively. Okay, what does it mean by retrospectively? It means that as if the policy had always been applied. So you have to adjust the opening balance of the equity item. Okay, if it is an SOPL, then you have to adjust the opening balance of the retained earning. Okay, if the item affected is a SOPL item, therefore you have to adjust the opening balance of the retained earning. So retrospectively means that you will apply the change to the earliest period reported in the financial statement. That's why the meaning of retrospectively, as if that the policy had always been applied. Okay, if previously you have using, for example, cost model for the PPE, now you are changing your policy to use the revaluation model. So you have to change, you have to adjust retrospectively as if that you have been using the revaluation model since the beginning. Okay, if it is impractical to apply the retrospectively due to lack of information, then you are allowed to apply the prospective method. Okay, and then accounting estimate. Okay, when we talk about estimate is where you need to make your own judgment. Okay, because even though the standard has provide you with the rules, there are certain things that is uncertain, that is unpredictable, but because you need to follow the conservative principle that we should not overstate our revenue, and if we foresee that we will incur certain losses or expenses, so we must report them. Therefore, we have to do some estimation, and a very simple estimation is when you sell your product on credit, you create a current receivable, and you need to be prudent. You need to estimate how much that you're not able to collect, so that will be the allowance for that. That is an example of estimation. And also another example is depreciation. You need to estimate how long the asset usage of the asset that can provide economic benefit to you, so you have to estimate the economic useful life. So these are example, okay, where you need to do your judgment based, of course, you have based on your experience and the relevant information that you have collected to make those reasonable estimation. And this estimation, because it is just an estimation, it may change later. Okay, so when there is a change in accounting estimate, it must be done prospectively. What does it mean by prospectively? The adjustment will only take effect in the current year and the future period, which means that you don't have to adjust the previous year based on your previous estimation. If you have a new estimation, those changes is effective in the current year and the subsequent years if relevant. So that's the difference between retrospectively and prospectively. Okay, so the effect of the change is accounted in the SOPL because it is a change in the current year. Therefore, it will affect the SOPL item if it involves SOPL items such as revenue and expenses. Okay, and if it affects your asset or liability, then you will do adjustment accordingly on those asset and liabilities account. Right? Okay. Okay. If there is a difficulty arises in differentiating whether those changes is accounting policy or estimate, then you will consider that as a change in estimate. Okay. Thank you. I stop here.